Hello and welcome to today's extensive weekend video, which is called Is S&P 500 consolidating or forming a bear flag, pennant, or whichever continuation structure you call it. I will be as well covering precious metals, meaning gold and silver, together with copper, Bitcoin, yields, and of course the driving force, the US dollar, what's been happening during the week and what we can expect going forward. Such was, at the start of Friday, the chart. Following the drop, you had seen gradual recovery, one more retest of the support level which I talked in Friday's video. I will be linking to it later on, and then return to buying together with closing price action right before the close when institutions are placing their bets. So it had been a sign in itself, which is exactly what I have been telling you about as well. Semiconductors showing relative strength regardless of Nvidia not being in the leadership position for most of that week. I've been highlighting the performance of financials, banks, and as well pointing your attention towards industrials, Dow Jones. This is the overlaid chart where you can clearly see end session buying in communications, which is very encouraging also in discretionaries, Nasdaq as such, high yield bonds, and S&P 500. These are quite constructive signs, and you see how relatively lagging semiconductors had been during Friday. This is the weekly chart and the market breadth. It doesn't tell us that much apart from the fact that stocks are consolidating here at the 50-week moving average, which roughly corresponds to the 200-day one on the daily chart. This is the daily chart, where we had seen a breakdown below that 200-day moving average, followed by retest. Quite a few of those latest daily candles had featured prominent upper knots, which is not exactly a bullish sign. Therefore, a relative caution and question marks to be raised and examined as regards the current daily chart structure. Is it forming a bear flag or pennant? Can you draw a channel? Can you just interpret it in any different continuation way? Or are stocks merely consolidating and taking a respite before trying to return on their upswing? This is the key question, and we will dive into it in the following charts. Thank you for liking these videos and subscribing to the channel. This is the perspective that various periods of moving averages give on the daily S&P 500 chart, where you can see that the percentage of stocks trading below the lowermost, which is the 200-day moving average, is still below the 50 demarcation point. So this is kind of still on a sell signal. 50-day, it's not exactly repairing its technical posture either. As well, it's not looking anyhow great. However, the 20-day or 5-day or 10 days, these percentages of stocks trading above these periods of moving averages would show a bit brighter picture, not too overbought on a very short-term basis, however quite vulnerable, and thus far those higher periods of those moving averages, the picture in there, that percentage of stocks picture, is relatively more slowly being repaired. So a bit of caution is in place, especially if you review as well prior week's presentation, where I had brought you this McClellan Summation Index and been highlighting how the internal strength of the stock market rally had been deteriorating ever since the pre-election times, and how the December FOMC flash basically and as well overcoming this level in the post-inauguration days had not been a game changer from the perspective of internal strength of the stock market advance, and actually that equities had been under a long-term distribution. This does not mean that we cannot trade counter-trend moves even on a swing trade basis, meaning that they can last more than a day or two. However, this is revealing the true setup of the market and which side is stronger. Worth watching is the slowly building, evolving, one in the making bullish divergence. As you can see, the pre-inauguration depths, and right now we are higher while the stock market prices are somewhere else. So worth watching how these two perform in the days and weeks ahead. Such is the daily perspective of the sectoral view, and you can see it has been quite a positive day if you glance over the financials performance. Let's refine that with the 5-day perspective so as to evaluate the whole week. Such was the situation given in 7 days ago weekend video, where I had been highlighting that it was just the defensive parts that had been performing well. You heard me as well covering multiple times the first sign of stock market turnaround in the near term, on the near term basis, that it had been the refusal to decline on frankly disastrous University of Michigan consumer data, and it had been followed by relative base building throughout the week, which is why in my eyes it is impossible to jump right on the conclusion that this is definitely a bear pennant, this is definitely a bear flag, this is definitely a consolidation before breaking lower again. And this is a clear evidence, because throughout this week, this 5-day perspective of the sectoral performance shows that okay, energy maintained its outperformance, however financials have returned back to life. There is a move underway in industrials, coinciding as well with what I see unfolding in yields and US dollar, and you can as well see the other ratio, not just financials to utilities, but as well discretionaries to staples, how for all the hammering that Tesla took during the week before turning up to finish yesterday, to finish Friday, we can see how discretionaries have outperformed staples. So these are signs that are actually constructive from the long-term basis, and I prefer to see not a short squeezy fast to the upside kind of move, but base building and slowly gathering internal strength, which is exactly what we want to see, and also mirrors the message of McClellan Summation Index that I ran a couple of slides earlier. coming back to the US dollar, you remember, as all these videos are connected to each other, so turn notifications on so as not to miss new content whenever it goes up, so that you can benefit right away, because this is a daily channel and I cover everything and I release the videos well before the opening bell for you. So here we can see my midweek call, how it had unfolded for the US dollar to rise, and it had been basing. It's arguably not yet totally done on the upside, but where we can look at the technical resistance, it's anywhere between 104.50 to 105.50. I don't think we go to 106.50. I don't think so. The conditions would be right for that. However, screenshot this and compare to the following chart, where you can see that the strength in the dollar was not nearly mirrored by commensurate advance in yields. It rhymes with the fact of what I had been telling you earlier in the week, when we see money flows to United States, to Europe, and to Southeast Asia, meaning Singapore, doing fine. This is a good sign still. So we are seeing yields being relatively well behaved, and there is one more point to make, and it is the fact that the US dollar ascent had been rather driven by appreciation against the euro than against the yen or the Swiss franc, which is really good and a sign of slowly emerging a risk on. And one more note as regards the US dollar is that when we see US dollar appreciating, this is increasing the attractivity of US equity markets for inflows, and it is helping to underpin. It is one more factor speaking in favor of stock market bulls and limiting the kind of downside that even the most bearish people could be seeing, meaning return to the clear downtrend and breaking below prior Thursday's lows, which is not my base case scenario at the moment. It would require a significant headline, the tariff situation spiraling out of control, and we are not yet there. We are not there at the moment at all. What we had seen throughout the week is as well calming down in weeks in the best known volatility metric. There are as well a few rejections of going higher. However, my preferred volatility metric, which is VIX to short-term VIX, forward-looking VIX, is painting a picture of continued caution, and it kind of mirrors the short-term indecision, where the scales are only very slowly being tipped one way, and it does not mean that we would not be facing daily downswings. That's why it's so important to be nimble in this market environment, because we have not yet seen a trend worthy of its name that would last more than 2 or 3 days when it comes to a developing uptrend or downtrend within the last, say, 6 trading sessions. We have not seen that. And this chart is exactly, if you count those candles, mirroring that situation perfectly. Now, moving on to cryptos, Bitcoin and Ethereum, they are not exactly reacting in a risk-on way. So this is still a matter of contention where I cannot be unequivocally bullish. It's impossible. Here I would be betting rather on the continuation to the downside rather here than in stocks. However, until we see a decisive moment of liquidity, global liquidity, returning and underpinning cryptos, it's impossible to say that. A couple of words regarding Wednesday's FOMC. Some people might be disappointed that QT had not been removed or fully out, that 5 billion remained. However, the reduction from 25 to 5 is still a huge one, and it can be even equivalent to more than one rate cut in everything but name. So that is something that is, of course, very much limiting the downside in cryptos, the downside in risk assets. And right before the FOMC, the much publicized short whale trade on Bitcoin had been reversed to the upside. So in here you can see as well the consolidation. And having said all of these, it's ever so slightly leaning sideways to up in the very few days ahead, unless the dollar starts biting. However, for now it is not the best risk-reward perspective point to initiate fresh longs in cryptos. One has to be very nimble in there and rather view it as a channel stills, meaning selling the rips and buying the dips with very tight open trade parameters. Reviewing gold and silver. Midweek as well, I had been not exactly midweek, because I would midweek from a calendar point basis. However, it was before Thursday's opening bell, so a little bit later than Wednesday. I had been calling for the precious metals correction to start developing, and it was as well the moment when the volume had clearly on a closing basis following Wednesday's session been drying up in gold. So it was clear that the yellow metal would be facing some kind of a downside pressure, and of course it's a matter of when and where the dip would be bought. For now, it remained above 3,000 on this chart. Silver had been hit much harder, and to give a little bit of a preview, I do not think that these woes are totally done, and there is more in terms of the corrective move combined in time and combined in price to play out still. This is the very first clear warning sign that all is not totally well in the bullish land, because whoever wanted to go into silver and gold had already done so, had been providing plenty of signals before the corrective moves late February or early March, when these corrections had been cut short and the sky had been again clearing up to the upside. This is not the situation right now. Right now the sellers have the initiative medium term, and it's important to realize that I had been one of those signs that made me call for caution in gold had been the slowing momentum, which you can clearly see on the MACD histogram. And now it's in negative territory and coming from below the force indexes as well, under the zero line. So this is just illustrating who is in the driver's seat, and you can see both lines on the Ichimoku cloud indicator system had exchanged their position, so this is not a time to be raging bullish in gold and silver. Absolutely not. I had been adamant since approximately midweek that it is essential to be protecting sizable open long gains that we have had in the metals. Here you can see greater silver vulnerability coupled with some kind of a short-term stabilization. So let's see whether it lasts, because it had been copper that was sending much more positive signs in its velocity to come back following Friday's early session weakness. And of course, copper does come back earlier when we have that great European initiative to go into debt so as to reindustrialize, rearmament, everything. My join page will help you select what's right for you based on what and how you trade. I can't stress enough the importance of having access to full scope daily analytics coupled with premium Telegram channels which give you intraday updates at turning points and essential crucial market action by asset. You know pretty well my professional journey and what it took to be independent, and all the twists and turns, how it had been going, and you can make sense of the great visual. My obligatory disclaimer, and for now just have a great weekend and let's talk soon again.